Got it. Running with China's stock market versus the USA stock market, since that's the comparison that fits the trending 2026 narrative. Here's the full script. Two of the biggest economies on Earth. Two completely different financial systems. And in 2026, the gap between them has never been more exposed. Somewhere in Shanghai, a young investor watches his portfolio drop 8% in a single afternoon, not because of bad news, but because of a government policy announcement nobody saw coming. Meanwhile, in New York, a trader watches a tech stock swing wildly, not because of government control, but because of pure, unfiltered public emotion. Two markets. Two worlds. Both chaotic. But for completely different reasons. This is the story of how two superpowers built two completely different financial systems, and why understanding the difference might be one of the most important lessons for anyone thinking about global investing in 2026. Let's start with a simple question most people never actually ask. What is a stock market really supposed to do? In theory, it's supposed to reflect the value of companies. When a business grows, earns money, and expands, its stock price should rise. When it struggles, the price should fall. Simple, right? But here's where the story splits into two completely different realities. In the United States, the stock market operates on something close to pure capitalism. Companies compete freely. Prices move based on earnings, innovation, consumer demand, and yes, emotion. The government rarely interferes directly with which companies rise or fall. If a business fails, it fails. If it succeeds, it can become a trillion-dollar giant almost overnight. That freedom is what built companies like Apple, Nvidia, and Tesla into global empires. But that same freedom is also what creates massive volatility, because nothing is protecting investors from irrational hyper-sudden collapse. Now here's where everything changes. In China, the stock market doesn't operate the same way at all. It looks similar on the surface, numbers, charts, tickers scrolling across screens, but underneath, it's a completely different machine. The Chinese government maintains significant influence over major industries, and sometimes, over the market itself. When stock prices fall too fast, regulators have stepped in before to slow the decline. When certain sectors grow too powerful, or too independent, policy changes can reshape entire industries almost overnight. Remember what happened to China's tech and education sectors a few years back. Companies worth hundreds of billions of dollars lost massive portions of their value within months, not because of poor performance but because of sudden regulatory crackdowns. Imagine spending years building a fortune in the stock market, only to watch policy decisions erase a third of it in a matter of weeks. That's not something most American investors have ever had to fear in the same way. But before anyone assumes the American system is automatically safer, here's where the story gets more complicated. Because freedom cuts both ways. Without heavy government intervention, the U.S. market has experienced its own devastating collapses throughout history, moments where panic, speculation, and greed created crashes with no one stepping in fast enough to stop the bleeding. The freedom that builds trillion-dollar companies is the same freedom that allows bubbles to form and burst violently. So neither system is purely good or purely bad. They're just built on completely different philosophies about who should control economic outcomes, the market itself, or the state. At this point, you might be wondering, which system actually performs better? And that's exactly where most people get the comparison wrong. Because it's not really about which market makes more money in a single year. It's about something deeper: trust, transparency, and predictability. In the U.S. market, information is public. Company earnings, insider trading laws, financial disclosures, all of it is heavily regulated to protect investors from fraud, at least in theory. When something goes wrong, there's usually a paper trail, lawsuits, investigations, accountability. In China's market, transparency has historically been a bigger challenge. Some companies have faced accusations of inflated earnings reports or hidden financial problems, making it harder for everyday investors, especially international ones, to fully trust the numbers on the screen. That's not a personal attack on any nation. It's simply a structural difference that every serious investor needs to understand before putting real money into either system. But here's where the story takes an unexpected turn. Because despite these massive structural differences, in 2026, something surprising has been happening. Global investors haven't been choosing one system over the other completely. Instead, many are diversifying across both, carefully, cautiously, and often through indirect exposure rather than direct investment. Why? Because both economies still represent enormous opportunity, just with different types of risk. The U.S. market offers innovation-driven growth, powered by technology, artificial intelligence, and consumer spending. China's market offers access to the world's largest population, an enormous manufacturing base, and rapid infrastructure development, even with the added uncertainty of political influence. It's like choosing between two different rivers. One flows fast and unpredictable, full of opportunity but occasional violent rapids. The other flows with more control, more structure, but sometimes gets redirected suddenly by forces upstream that ordinary people never see coming. Neither river is safe. Both require respect, patience, and understanding before stepping in. Now here's the part almost nobody talks about. The real danger for everyday investors isn't choosing the wrong country. It's assuming they understand a system they've never actually studied. Too many people jump into unfamiliar markets chasing headlines, a viral stock, a trending sector, a friend's exciting story, without understanding the deeper rules governing that specific economy. That's how life savings disappear. Not through bad luck, but through blind confidence in systems people don't actually understand. And this is where everything becomes interesting. Because the deeper lesson here isn't really about America or China specifically. It's about a truth that applies to every market, everywhere, at every point in history. Every stock market is a reflection of the values of the country that built it. America's market reflects freedom, innovation, and risk tolerance, for better and worse. China's market reflects control, stability seeking, and centralized planning, also for better and worse. Neither is purely right. Neither is purely safe. They're mirrors, each showing a different vision of how a society believes wealth should be created and controlled. So if you're watching this in 2026, wondering where the smarter opportunity lies, the honest answer is uncomfortable but important. There is no perfect market. There is no guaranteed system. There's only informed decision-making, patience, and respect for risk, no matter which country's economy you choose to bet on. Because in the end, whether you're watching numbers rise and fall in New York or in Shanghai, one truth remains exactly the same on both sides of the world. Markets don't just measure money. They measure human trust. And the moment that trust breaks, in either direction,